All right, let's kick off part one discussing market valuations and the implications for future returns. And this here basically summarizes the entire part one of what I'm about to discuss, which is that the 12-year projected return of a 60-40 portfolio, and keep in mind a 60-40 portfolio means 60% stocks, 40% bonds, so kind of the classically diversified portfolio. In any case, the projected return of that portfolio has declined to the lowest level in history aside from the week of the 1929 market peak. Again, the expected returns for a 60-40 portfolio are now lower than they've ever been in history except for the 1 week at the top of the 1929 market peak. And keep in mind, as I go through some of this, the valuation data provided is from Dr. John Hussman. He's done wonderful, extensive work on market valuations. So I believe it's the most, I think it's the best source out there. The blue line in this chart shows the projected returns throughout time going back to 1928. So the higher the line, the better the return outlook was, and the lower the line, the worse the return outlook was. So we can see it's a pretty cyclical metric. We go from periods of very low expected returns to periods of high expected returns and back down again. So again, the blue line is the projected returns. The red line is the actual returns experienced on an annual basis for the next 12 years. So you can see that the actual and the estimated returns align pretty darn closely. So I have a lot of confidence in this measure. Now, there are periods of time where there's a discrepancy, a significant discrepancy. For instance, in the 1940s, the expected return was about 14% a year for the next 12 years. The actual return was closer to maybe 12% a year. More recently, in 2006, the expected return was about 4% a year for the next 12 years, and the actual return was closer to 8% a year. And of course, that deviation from the fundamental estimated return is what causes the extreme situation that we have now, because returns have been so good for so long and so much better than what the fundamentals would indicate, that now we're in a position of even more extreme valuations. And that means the projected returns for the next 12 years from here are very, very low. In fact, they're about 1% or less per year for the next 12 years. The only time the projected returns have been lower than the current projection is, again, at the very top of the 1929 roaring 20s bubble right before the Great Depression, when stocks lost 89%. And again, even in that situation, the projected return was maybe barely above break even, and the actual experience was actually 12 years of negative returns. So the question is, how do you estimate forward returns? Well, the bond part of the equation is really quite simple. If you bought a 10-year Treasury bond today, that's yielding about 1.8%, and you hold it to maturity, you're going to get your 1.8% per year, and that is your return. Now, there may be some price fluctuation along the way if interest rates rise or fall, but just buying it now and holding it to maturity, that is your expected return. So the bonds are pretty easy. The question is, how do you estimate returns for stocks? For this, I think it's better to take a step back and have a brief refresher on what we're buying when we buy a stock. So when we're buying a stock, you're essentially buying a stream of future cash flows, and the price of the stock is the amount you're willing to pay for that future stream of cash flows. So the ratio of the stock's price to its stream of future cash flows can vary over time, and this is a valuation ratio. Now, a proper discounted cash flow analysis can be pretty complicated, so many of the valuation ratios we use, like price to earnings and forward PE and many others, are really just shorthand for a proper discounted cash flow analysis. Keep in mind, some valuation ratios are better than others, meaning they are more reliable for predicting future returns than others, so you have to be very careful of the ratios you're using. Now, very low valuation ratios indicate better than average future returns, while high valuation ratios, where the price is very high relative to the expected cash flows, indicates lower than average future returns. An example of this is, imagine you want to make an investment into an asset that is expected to deliver $100 10 years from now. If the price of that asset today is $90, you're expecting to make a $10 profit on your $90 investment, or about 11% for the 10-year period. Now assume that that same investment with the same $100 cash flow in 10 years is priced at $50. Well, now your expected profit is $50 on a $50 investment, or 100% return for that 10-year period. So the price you pay, all else being equal, determines your return. Okay, let's switch gears briefly here for a moment. Most people, especially baby boomers and older generations who invested throughout the 80s and 90s, understand that the long-term average return for the stock market is about 10% a year. The problem is they heavily rely on that when they do their projections for retirement going forward. Now, these folks understand that year to year the returns can certainly vary. But I think what most people find surprising, at least based on my conversations with folks, is that the returns from decade to decade can also vary widely. Most people seem to believe that if you looked at returns for any 10-year period of time, that they come pretty close to averaging about 10% a year, because the good years and the bad years average out, and so 10 years is a long enough period of time where the long-term returns could be achieved. But the actual experience is quite different, as we see here in this chart, which shows the decade returns for the S&P 500 going back to the 30s. We notice that there are actually 2 decades where the S&P 500 went backwards, and then the 40s, 60s, and 70s had very low returns, positive but very low returns. And then we had a couple good decades as well, like the 80s, 90s, and 50s. So when we break this down, we see 4 out of the 9 decades exceeded 7% annualized growth. And this is price only, not including dividends. 2 out of 9 decades produced losses, and 3 out of 9 decades produced somewhere between 0 and 7% annualized growth. The point being that over half of the last 9 decades either produced losses or below average growth. That's pretty incredible, and I find most people are quite shocked by that. So why is this important? Well, the sequence of returns matters. So, for instance, if you retired in the 80s and you had the large returns of the 80s and 90s, chances are your retirement looked far better than what you were planning going into retirement. So either you could expand your distributions from your portfolio and increase your lifestyle, or your net worth is much larger and you have more assets to pass to your heirs and charity. Now, conversely, if you retired in 2000 or 1930 or 1940, 1960, chances are your retirement was much tighter than what you were planning. You may have even had to reduce your retirement spending, or maybe your net worth is lower than what you planned on, and you're not able to pass on nearly as much as you were hoping to. So the question for me and my job is, how do you anticipate if we are about to embark on a good decade or a bad decade? And that's where the valuation ratios come in. So again, I have the one valuation metric here, and this is from Dr. John Hussman. This is one of the most reliable valuation metrics, and this one goes back to 1928. So if I look at this and I overlay the best 3 decades from the previous slide, sure enough, we find exactly what we'd expect, which is that when the market is very cheap, the returns for the next decade are very high. Conversely, when we're investing at very expensive markets, we see that the returns for the next decade is very low. So we have the peaks here, and then we have the troughs here. So when we look at the current valuations today, which exceed both extreme periods of the dot-com bubble and the Great Depression, it seems obvious that we should not expect really anything close to historical average rates of return. Yes, stock markets have provided 10% a year for a very long period of time, but as we know from the previous slide, the decade returns can vary considerably. So more likely than not, the next decade is going to be very difficult for stocks. In other words, the U.S. stock market is currently priced to deliver the worst 10-year returns in history. Why? Because the valuations are more expensive than in history. Now, the good news is that the low returns probably will not be a consequence of statically low returns for 10 years. In other words, we're not assuming that the stock market is going to provide 0, 1, or 2% returns every year for 10 years. More likely than not, it's going to be characterized by a sharp downturn or a bear market and a recovery. So that when you look over the past 10 years, at some point, we'll find that the market basically went nowhere for a decade. And that's typically what's happened. In fact, we've never had this extreme of a valuation without having experienced at least a 45% decline in the stock market. So we see that in 2007, 8, and 9, the market lost 55%, lost about 50% in the dot-com bubble, about 50% in the mid-70s, and then, of course, we've got the Great Depression where the market lost about 90%. So more likely than not, there will be a severe bear market and recovery, and that is actually an opportunity for investors who are disciplined and aren't overweighting stocks in their portfolio now at the valuation peak, and have the discipline to preserve some dry powder that can be deployed once stocks have fallen and their projected returns are much more attractive. These are some other valuation metrics here just compiled by Crescat Capital. These are all fairly reliable valuation metrics, and we can see the story is the same. All of these are in their top few percentile, meaning they're more extreme than ever before. This chart is showing you the percentage of new initial public offerings with losses. So in the dot-com bubble, if you recall, companies like Pets.com and others that would come to market with huge losses, but the market didn't really care about the losses. Investors were more concerned about clicks and eyeballs on their websites. They thought that was a more important metric. So people were bidding up these money-losing companies to extreme levels, which is why the valuation ratios became so extreme in 2000. Well, now, just recently, we've actually surpassed that, where there's a greater percentage of IPOs coming to market now with losses than there were in 2000. And here I'm showing equity earnings growth minus the inflation rate to determine what the real growth rate for earnings is in the U.S. stock market. And we can see that it's actually been contracting year over year, which is typically associated with recessions. Okay, so that wraps up part one. Valuations aren't great for timing. They tell us a good deal about what we can expect for the next 10 to 12 years. So that helps us with our positioning of portfolios. That helps us with our financial planning and our retirement planning. But it does not help us with timing. So in part two, I'm going to talk about some factors that may be better for helping us identify the timing of when a market could top out. So stay tuned.